Hello, welcome to EagleStocks, and today's episode I'm not gonna talk nothing about my portfolio. I'm just gonna show you how I look at a company's numbers on Yahoo Finance. So first, I always go to the statistics, and this is how I can tell if the price is overpriced or it's underpriced. So I will go to the 5-year average yield. This is for stocks that have dividends though. So you go here, you look at the 5-year average, which is 5.21, and you can see that that's lower than its current. So if this number is bigger, that means the company is undervalued, because when price goes up, dividend yield goes down, and when price drops, dividend yield goes higher. So you can see that there. Another thing I look up is the financials. I like to see the revenue, how it's been growing and stuff. Green is for the revenue, and this is for the actual money they earn. You can see that it's been going up, and I think that's due to tax cuts and stuff like that. So that's something we want to keep in mind when buying. Another stuff I like to look at the return on assets and return on equity. The payout ratio is really important, because you always want to buy companies with a reasonable payout ratios. You don't want to buy a company that has like a 200 payout ratio, because that's really hard to maintain over a long period of time, unless they're like they keep up with inflation, they keep up with their cost for the products, and they keep up with bringing products like all the time. That's really hard over a long period of time. I like to see the cash amount, the total debt too. That's really important, and the ratio too, because if they have a crazy ratio, that means that if something was to go wrong, let's say they have extra cost, I don't know, tracks breakdown, stuff like that, and they need to put more money, they're gonna be more in debt, and you don't want to buy companies that have crazy debt ratios. I like to see the cash flow, not so much, don't worry too much about this. And then I like to look at two very important things when buying. This is especially because you don't want to buy a company that has a P ratio like crazy, like 200 or 300 or even higher. Average of this is 25, and 20 is the best, I guess. I have a special formula that I read in one of the books about investing, that it was get the discount 20 minus current inflation rate, and that will give you the best P ratios to buy at that inflation rate point. So P ratio stands for price earnings. So that means you pay $6.39 for $1 in profits, and then earnings per share means how much earnings you get per each share. So you get $4.95. It's not that bad. That's just so you see. And a very important thing I like to look up is at the financial, and then you go to balance sheet, because here you can see the total amount of assets and the total amount of liabilities. You don't want to buy a company that has more liabilities than assets, because on the long term it's not going to be profitable, and you're probably going to lose your money if you invest in that. So I see a lot of people that ask me about options and stuff, but for right now I'm going to teach you a little bit about the stocks, because the option thing is more complex, and since options are more complex and you probably need to get a better knowing of how to run the charts, I'm going to leave that aside. So I hope you enjoyed today's video, and next video I'm going to tell you what's the right numbers when you look at the fundamentals to buy. So have a great day, and peace out.